If you have even €1 invested in Europe, you're probably exposed to a $900 billion ticking time bomb. This isn't some emerging market gamble or a speculative crypto asset. This is in France. One company in one sector holds a liability equal to 45% of the entire French economy. And it has the potential to cascade across every European asset in your portfolio. What really gets me is that the big institutional players are either missing this completely or they're quietly repositioning, betting that you won't connect the dots until it's too late. Let me show you exactly what's hiding inside your European exposure. The company is EDF, Électricité de France, the state-owned energy monopoly. Right now, it's carrying $900 billion in documented liabilities. This isn't an exaggeration. It's a combination of corporate debt, unfunded pensions, and the staggering cost of dealing with 56 aging nuclear reactors that are all hitting their expiration date at the same time. Here's the critical part. France built most of these reactors in a single decade. Between 1977 and 1987, they used identical designs and the same components, which means they have synchronized aging schedules. Today, the average reactor is 39 years old. Their original design life, 40 years. Now, you might think, okay, they'll just build new ones. But look at the data. France's flagship replacement reactor project, called Flamanville, is a financial disaster. It went over budget by 479% and is already 14 years behind schedule. If even half of that cost overrun happens when they try to replace the whole fleet, every official projection is basically worthless. And because the French government owns 84% of EDF, every single euro of that loss transfers directly onto France's national debt. That same debt is held on the balance sheets of banks all across Europe. It's used as collateral by the European Central Bank. It's woven into the cross-border lending between banks. And yes, it's almost certainly in the European bond funds sitting in your retirement account. The market is already starting to wake up. The extra interest France has to pay on its bonds compared to Germany has more than doubled since 2021. The smart money, the institutional capital, is already moving out, but they're doing it quietly. The real question is, are you going to get ahead of this, or are you going to be left holding the bag when the real repricing happens? Let's break down that $900 billion liability. First, according to EDF's own 2024 annual report, there's €65 billion in direct corporate debt. Second, France's Court of Auditors reports €50 billion in unfunded pension obligations. Third, and this is the big one, is the cost of decommissioning all those old reactors and overhauling the infrastructure. EDF estimates a lowball figure of €100 billion. But independent analysts at major banks like Citi and Deutsche Bank, who factor in historical cost overruns, put that number closer to $150 billion. And these costs aren't spread out over 50 years. They are converging within the next 15. We already got a preview of what happens when things go wrong. Between 2022 and 2023, EDF had to shut down half its reactors for emergency inspections because of corrosion cracks. This happened during a massive energy crisis in Europe. The result? EDF posted a nearly €18 billion loss in a single year, and the French government had to inject almost $10 billion in emergency cash just to keep it solvent. That was from one issue in 1 year. Imagine that scenario scaling up as more reactors age and more systems begin to fail. France's national debt is already at 112% of its GDP. The official limit for the Eurozone, a rule France helped create, is 60%. Every billion the government pumps into EDF makes that problem worse. And because French debt is so deeply integrated into the European financial system, this risk isn't isolated to France, it's systemic. The Flamanville reactor project gives us a real-world look at replacement costs. It started in 2007 with a €3.3 billion budget, supposed to be done by 2012. As of today, it's still in the testing phase, and the cost has ballooned to €19.1 billion. That's a 479% cost overrun and a 14-year delay. If we apply just half of that overrun rate to the 56 reactors that need replacing, we're looking at an extra €200 billion on top of official estimates. EDF's credit rating is just 3 steps above junk status. It can't borrow money cheaply anymore. This leaves the French government with 3 terrible options. Keep bailing it out forever, absorb the company entirely onto the national balance sheet, or let it go through a restructuring that would send shockwaves through the entire European utility market. None of those outcomes are good for your portfolio. So I need you to answer this question for yourself. What percentage of your investments is in European government bonds, European utility stocks, or funds with heavy exposure to France? Take a look at your holdings. There's a $900 billion problem in France's energy sector that most people are overlooking, and it's not a future risk. It's happening right now. Let's break it down. First, EDF, France's massive state-owned energy company, has a serious pension problem. The system was designed when life expectancy was 68 years. Today, it's 82. This means the pension fund is paying out far more than it was ever designed to. The fund holds about 22 billion euros in assets, but its liabilities are a staggering 72 billion euros. That's a 50 billion euro shortfall, and it's growing by 2 billion euros every single year. By law, EDF has to cover this gap from its operating revenue. But here's the catch. Its revenue is falling while the costs to maintain its aging nuclear reactors are soaring. This isn't just a temporary cash flow issue, it's a structural deficit. So, how do you fix a 50 billion euro hole? You either cut benefits, which is a political nightmare, or you get a taxpayer bailout, which adds even more pressure to France's already strained national budget. But this isn't just France's problem, it's Europe's problem. France is the continent's largest net exporter of electricity. Countries like Belgium, Italy, and Switzerland rely heavily on French nuclear power to keep their lights on, especially during winter. Belgium imports around 30% of its electricity from France. Italy needs French power to balance its grid, which is heavy on renewables. Switzerland uses it to manage its own hydroelectric output. We saw what happens when this system breaks down. During the winter of 2022, French nuclear plants were down for maintenance, and for the first time in modern history, France became a net importer of electricity. The ripple effects were immediate. Belgium had to fire up old coal plants. Italian electricity prices shot up past 500 euros per megawatt hour. The entire European electricity grid is built on the assumption that French nuclear power is always available. When that assumption fails, the economic consequences are huge, affecting everything from German manufacturing to Dutch data centers. This instability also threatens France's role as a global leader in nuclear technology. France is building reactors in India, China, and the UK, but its credibility is tied to its success at home. With major delays and cost overruns on its own projects, international buyers are getting nervous. If France can't keep its domestic fleet running smoothly, those lucrative export contracts could dry up, adding even more pressure to its economy. The financial markets are already sending warning signals. The spread between French and German 10-year government bonds has more than doubled since 2021. This is not just market noise. It's a quiet, steady exit by major investors who are reevaluating the risk of holding French debt. They are gradually moving their money before the wider market catches on. Once that spread hits 100 basis points, the big institutional players will have already repositioned themselves. So what does this mean for your portfolio? It's time to ask some tough questions. If you have significant exposure to European utilities or sovereign bonds, you need to stress test your holdings. Run the numbers. What happens if French debt gets repriced, if EDF needs another massive government bailout, or if nuclear output drops by 15%? These aren't wild guesses. They are plausible scenarios based on current trends. The structural risk is already here, propped up by government funds that are just adding to the national debt. Is your portfolio prepared for the moment the market reprices this risk? I've put together a comprehensive risk assessment that dives deeper into these scenarios with detailed analysis and specific strategies. You can find the link in the description below. Subscribe for more institutional-grade research that gets ahead of the headlines, and let me know in the comments which market we should audit next. Germany's green energy transition, Italy's debt crisis, or the UK's grid reliability. Thanks for watching.